Crypto lending deposits have. From 125B peak to 60 by dog, crypto lending deposits have nearly halved from their late 2025 high, sliding from $125 billion peak in October 2025 to roughly $60 billion, according to a June 8, 2026 update from Cointelegraph. The drop quantifies a deleveraging cycle that traders have felt for weeks but rarely see measured in a single figure. The data lands in a market already under pressure. As of June 8, 2026, CoinMarketCap's Fear and Greed Index sits at 15 deep in extreme fear. Bitcoin trades at 63,337, down 10.84% over the past 7 days. Ether is at 1694, off 14.93% on the week, and Solana has dropped 16.87% to 6707 over the same stretch. A 50% contraction in lending deposits fits that backdrop rather than contradicting it. A credit cycle running in reverse. Lending deposits are the supply side of on-chain credit. Users deposit assets into protocols, borrowers post collateral and draw against that pool, and the spread between deposit and borrow rates clears the market. When deposits roughly double a market's size on the way up, leverage builds. When they fall by half, the opposite happens. Positions close, collateral gets withdrawn, and the capital that funded borrowing leaves. The October 2025 peak of $125 billion came near the top of the last leg higher. Having that figure to around $60 billion is a return to levels last seen before that run, not an anomaly. Falling token prices do part of the work mechanically, since a deposit denominated in ETH shrinks in dollar terms when ETH falls 15% in a week. The rest is real withdrawal as depositors pull capital during a risk-off stretch. Thinner pools mean softer yields. For depositors chasing yield, a shrinking lending market cuts two ways. Less supply can push borrow rates up when demand holds, which lifts deposit yields. But in a deleveraging market, borrow demand falls faster than supply, so rates compress instead. The result is lower passive returns on stablecoins and major assets sitting in lending protocols, right when holders most want a cushion. That matters for anyone using yield to subsidize spending. Some staking and yield cards and stablecoin strategies depend on the same on-chain rates that lending markets set. When the deposit base halves and yields soften, the math behind funding cashback rewards or earning on an idle balance gets tighter. A strategy that penciled out at October rates may not at June rates. Counterparty exposure comes back into focus. Sharp contractions in credit markets also resurface a question that quiet periods bury. Who holds the assets? A deposit in a lending protocol is an active position, with smart contract and liquidity risk, not idle cash. During fast withdrawals, utilization can spike, and depositors can find that pulling funds is slower or costlier than expected. The same logic extends to custodial spending products. Balances parked with a custodial issuer carry counterparty risk, as the FTX and Wirecard collapses showed, where user funds were frozen or lost when the operator failed. Users who want to keep credit market stress at arm's length tend to favor spending from their own wallet, which removes the issuer as a single point of failure, even though it does not remove market risk. A measured signal, not a verdict. A 50% drop in lending deposits is a large move, but it describes positioning, not direction. Credit contractions have preceded both bottoms and further declines. The figure says capital has left on-chain lending, and that leverage is lower than it was 8 months ago. It does not say where prices go next, and the extreme fear reading at 15 is itself a contrarian indicator some traders watch for exhaustion. The clearest takeaway is structural. The on-chain credit base that powered late 2025 yields is half the size it was, and the rates built on top of it have compressed with it. Anyone relying on those yields to fund spending should recheck the numbers against current rates rather than last autumn's.